Hello everyone and welcome to another video. So in today's video we will be discussing a very exciting topic that many investors are curious to know about. Okay, so we are going to discuss top 5 mutual funds which you can invest in 2024 for your long-term growth. Okay, so with so many options out there, choosing the right mutual fund will be slightly difficult, but I have done the research for you. Don't worry, and I've got everything covered. So in this video, we will be discussing why investing in mutual fund is a great option. Okay, and the criteria for selecting the top performing funds, and I'll demonstrate that also, and I'll tell you the picks that I have done and the 5 mutual funds that stand out in 2024. So let's dive into this. Okay, let me change the slide. Okay. Now let me start by addressing this question before we jump into the list. Let's quickly talk about why mutual funds are very popular investment option in India. See guys, mutual funds pool money from multiple investors and invest in a diversified portfolio of stocks, which can give you better returns, bonds, which give you moderate return, but safety is there, or combination of both. Okay, so by investing in mutual funds, you get the benefit of diversification because you might not have that much funds to diversify. So here you get the benefit of diversification so that the risk will come down, and the professional management, those who know the deal, they are going to play the game. They know the rules of the game and they are playing the game for you. And that is actually very easy investment also. So that is again one thing. And liquidity is also there. When it comes to mutual funds, you'll get that liquidity at the same time. Professional management is also there, but compared to fixed deposit, it's slightly more risky. Mutual funds are subjected to market volatility and other things. But so you see, if I want to give an example, rather than buying shares of 5 different companies yourself, in terms of diversification, you may try to buy 5 different companies. You can invest in a mutual fund that already holds those shares. You got my point. So this way, basically, you are reducing your risk and simplifying your investment process actually. And mutual fund also come with different risk levels. You can choose funds that suit your risk appetite and financial goals. There are mutual funds which are specific to small cap where slightly risk is more, or medium mid cap where medium risk is there, or the blue chip companies also. So based on your risk appetite, you can do the investment. Now, let's look at the criteria for selecting the mutual funds. Okay. Now, see, with hundreds of mutual funds in the market, and how do you pick the best ones? That's a bigger question that that's a question that I always get. And you can see these are the criteria: past performance and consistency. See, performance in the past is not a surety in the future. That's there, but you can see the consistency over a period of time. So you need to look for the funds that have consistently performed well over the past 10 years. Okay. And while past performance doesn't guarantee the future return, I repeat that again, because you see that in advertisements also as a disclaimer, but it's a good indicator of the fund's stability. Right. So what returns it has been given over the past, let's say 5 years, if you see the cumulative return which has been given, that will give you a very good idea about how the fund is managed and how it is performing and other things. Second, and the most important, but it's actually the one which is, ignored by most of the investors, but still, anyway, it is negligible compared to the return. That is the expense ratio. So the expense ratio is actually the annual fee that the mutual fund charges to manage your investment. So the lower expense ratio means more of your returns stay in your pocket. Let's say you're getting, let's say 15%. If your expense ratio is 2%, then effectively you'll be getting 13%, right? So if the fund's expense ratio is, let's say 1%, you're paying rupee 1 for every 100 rupee which you're investing. That's how it is calculated. So when expense ratio comes down, the profit that you get will be more, right? So that's what the idea. Now, fund manager's track record. That's again a very important criteria. A good fund manager plays a very crucial role in the performance of any mutual fund if you take. So look for managers with a proven track record of delivering result, even during the volatile market conditions, how he managed, during the volatile market conditions also. And coming to the next one, risk and volatility. Understand the risk associated with the fund. Equity funds have high risk, but also higher returns, while debt funds are more stable. So choose a fund based on your risk appetite and investment horizon. So sometimes, you may choose to take more equity and less of debt, or if you want to have a more safer option, more debt and less of equity, that kind of, permutation combination you can look for. Asset management or asset under management. See, funds with a higher AUM, that's what AUM usually indicate that more investors trust the fund. So by looking at AUM itself, you can understand the trust on that fund when you see from the side of investors. So, but however, if you see, a very large AUMs can sometimes hinder growth. So it's essential to strike a balance, because very large AUM means see, the percentage gain you always get when it comes to numbers low, right? But when you choose low numbers, that will be more risky also. You don't have the credibility. When it goes higher, the percentage will come down. So here, the diversification will be a problem, and mostly they will look for very stable investments. So the return will be lesser when it comes to higher AUMs. So you need to make a balance. So try to strike a balance and taking a middle range. Now let's move on to the actual topic, the top mutual fund picks that you can see here. See, there's a main topic, the top mutual funds to invest in 2024 for your long-term growth. So these funds has been chosen based on the criteria which I have discussed before and the reasons which I've already told you. So see, let's look at Axis Bluechip Fund first. If you look at the overview, Axis Bluechip Fund is an equity mutual fund that primarily invest in large cap companies. So large cap companies are well-established firms with strong track records, making them a relatively safer option. So predominantly equity options, but again, large cap, which again making it as a safer option. Within equity, large cap is more safety. Now coming to the performance, if you see over the past 5 years, Axis Bluechip Fund has delivered an average annual return of 12 to 14%, which is decent and outperforming its benchmark consistently. So there is a consistency and there is a decent return also. So this consistency basically makes it a reliable choice for long-term growth. That's why this comes in one of the option. Now, expense ratio, if you see, the expense ratio of this fund is around 1.7%, which is quite reasonable. And it is managed by one of the top fund managers in the industry with a history of navigating markets ups and downs effectively. So that side is also very clear, expense ratio fund manager. Now, if I want to give an example, for instance, if you have invested 1 lakh in this fund 5 years ago, your investment would have approximately doubled, close to double at this point of time. Not bad, right? With you are getting, no headache. So that is actually a good scenario. Now coming to the next one. Yeah, MAE Bluechip Funds. Okay, so Mirae Asset Emerging Bluechip Fund. I don't know how you pronounce it, but whatever. So this fund basically invests in mix of large cap and mid cap companies. That's why you will see slightly more return compared to investing in large cap companies alone. So it's offer a blend of stability and growth potential. Why there is a possibility of more growth is because mid cap. Okay, large cap, the potential growth is not as high as mid cap. So, but risk is also high here compared to that. Mid cap companies often have more growth potential, of course, than the large cap companies. I told you when it comes to percentage, right? Now, this, if you see the performance, consistency is there. And when it comes to the consistency, it have actually outperformed its competitors also. And you can see delivering an average annual return of around 16 to 18%, which is remarkable in the last 5 years, which is actually very good. Expense ratio, if you look at, it's around 1.88%, which is again very good. It's a very, very good value for long-term investors. And the fund manager also have a proven track record identifying high growth mid-cap companies earlier also. So that's again good in this situation. If I want to give you an example, if you have invested 1 lakh again in this company 5 years ago, it would have nearly worth 2.1 lakh, something 2.2 lakhs like that. So it would have been, it's again a very, very decent amount which you can actually get. Now coming to the next one, SBI Small Cap. So here it is small cap. So the return will be slightly more higher than mid cap also, but risk is also higher. Large cap return may be less, but risk is less. Okay, mid cap return may be higher than large cap, but risk is also higher than large cap. Small cap return will be good, higher than even mid cap also, but risk is also higher. So if you look at the overview, this is again an aggressive mutual fund that focuses on small cap companies, and small cap companies have a higher growth potential but can come with high risk also. Okay, now if you look at the performance last 5 years, small cap fund have delivered an impressive average annual return of 20 to 22 percentage. It's a deal for it's a very good deal actually. And see, if you have slightly higher risk appetite, higher risk appetite doesn't mean that you are going to lose money, right? So if you have higher risk appetite, there's a better deal for investors. Now coming to expense ratio. It's again very decent. The expense ratio is slightly higher, but still it's okay compared to the previous one, which we have discussed. It comes around 2%. But you look at the return. And if you look at the return, don't you think that the expense ratio justify the cost? Right. So looking at 22%, expense ratio is what, 10% of that, which is justified, right? So in terms of percentage, if you see previous cases, expense ratio is higher because the return was actually lower in that case. So if you have invested around 1 lakh 5 years ago, it would have grown to 2.5 lakhs, which is very good at this point of time. Okay, now coming to HDFC Hybrid Equity Fund. See, for those who are looking for a balance between equity and debt. Okay, so here there is going to be a balance between equity and debt. So HDFC Hybrid Fund is a great choice for you. And this fund invests around 65% in equity, which is again a very decent proportion, and the rest in the debt instruments, providing a mix of both growth and stability. So debt instruments, it is risk free. Okay, so performance, if you see, the fund has delivered an average return of around 10 to 12% over the past 5 years. So if you are conservative, and still if you don't want to go for fixed deposit and get more return, then this is a best option for you. So I've covered, see, why I've selected these is because by looking at different aspects, conservative people, okay, mixed between debt and equity. Within equity also large cap plus mid cap, then mid cap, small cap, like that I have taken different combinations. If you look at the expense ratio, it's again not that attractive compared to the previous one, compared with the return. So it's around 1.9%, but it's okay. Again, it's a moderate, and the fund manager is very experienced and is having very good knowledge in balancing risk and return effectively. If you have invested 1 lakh 5 years ago, it would have grown to 1.6 lakhs, something like that by this time, with a very less risk exposure compared to the pure equity funds that we have discussed before. Now, next is purely the bond. Complete safety is there. Okay, so ICICI Prudential Bond Fund. For very conservative investors. Normally, I won't suggest this if you are below 40, 45 years, you can still go for any of the above. Even in that, if you're conservative, you can go for the HDFC hybrid one. Okay, but this is for very conservative people who are above 45 or 50. So, ICICI Prudential Bond Fund offers a very safe investment option with a focus on basically debt securities. So it provides stability and regular income, making it an ideal choice or ideal for those who are looking for very, very, very low risk. There is no risk involved actually here because it's completely on bond. But you can see the return here, it's around 7.8% annually over the last 5 years. With respect to expense ratio, there is nothing. It's around 0.9%, less than 1%, which is good and very cost effective. And the fund manager also have a very good, maintain the quality of the portfolio that you can see the selections and everything is very good. So that's why it actually came in the list itself. Okay. So if you have invested 1 lakh in this fund 5 years ago, it would have been close to 1.4, 1.5 now, but without any risk. Okay. But still it is beating inflation. That's something which you need to consider. Now, how to invest? This again we need to discuss, right? So how do you invest in these top performing mutual funds? How we can do that? So first, you need to choose the investment platform. You should be knowing that you can select a trusted platform like any. I don't want to make any recommendation. It could be Zerodha Coin or Grow or your bank's investment portal. Any. Okay. So these platforms basically provide easy access to mutual funds with detailed information on each fund. So you can see the details, and with your bank's portal also you can try that. And you select SIP or lump sum. Decide whether you want to invest through a systematic investment plan, SIP, or a lump sum. SIPs are a great way to invest consistently over a period of time. So in all the ups and downs, you will be part of the market move. So that give you a better average if it is SIP. The issue with lump sum is you are going for lump sum today. What happens tomorrow, you don't know. So there may be, if you invest all your amount lump sum today, then if it goes for a big dip and if it takes time for recovery, that affect your mental peace. But when it comes to SIP, you are throughout the market cycle, you are part of the market, and your investment is also part of that. So it will steadily grow. You get the better average also. If it is down, you get that advantage. If it is up, then also you're investing. So you get the average for sure. Okay. So lump sum is also good, but the problem is with timing the market. Maybe you will see a dip, then that may affect you also. Okay. So try to set up an auto debit. For SIP, set up an auto debit from your bank account to automate your investments, and this way you won't miss any SIP installment, because maintaining that consistency and discipline is very important and part of wealth management and wealth building. So if you have any questions and queries, you can get in touch with me. We'll help you in investment part. Okay. And I will guide you in that and will help you to take the appropriate choice also. So we can discuss upon that. And coming to the final conclusion part. Yes. Right, guys. Again, start small and gradually increase. So if you are new to mutual funds, now you need to understand how it works and other things. Okay. So start with a small amount in SIPs and gradually increase your investment as you gain confidence. And this is something which you need to do. Stay invested for long term. Wealth is not built in short term. It takes time. It needs time. So give time for your money to grow. So mutual funds are designed for long-term growth, and don't panic during short-term market fluctuation. It can come down, but it will eventually pick up. So this is designed for long-term growth. India grow, market grow, your money will grow. Don't worry about that. So stay invested and trust the process. Always keep reviewing your portfolio. Keep an eye on your investment and review your portfolio at least once in a year with the help of a mentor. You need to have a mentor. You need to have, an expert support or your financial advisor. And this will actually help you to stay on track with your financial goals. Now, see, that's what I wanted to discuss about this video. We have just started the series, so we are doing some small videos, and specific to mutual fund, I have a plan to, discuss separately. So, this is what the top mutual funds to invest in 2024 that I have decided. So that's my decision, and that's what I have understood from my, calculations and other things. And I hope you find this video very helpful and useful, and that will help you to select the best funds and help you to invest at least a small amount. So I recommend you to invest a small amount. Start investing. Start growing your wealth. It takes time, but do it consistently. Do it with discipline. If you want any support, you can get in touch with us. Remember, mutual funds are a powerful tool for wealth creation. Okay, but only when used it wisely. So that's it, guys. Thank you so much for watching. See you again in the next session.